Hi, everyone. We've dealt with the understanding of, the meaning of what is an interim financial reporting and the need thereof, and also looking at the, terminologies like a complete versus a condensed financial statement, set of condensed financial statements. We'll just take that discussion forward, and we would now like to talk about the specific cases in terms of how they should be dealt with in the reporting period framework when they relate to, let's say, a less than 1 year's accounting period, on a quarterly basis, for example. Okay. The first case that we want to talk about is if in case there is a planned periodic maintenance or overhaul, right? That is something which you want to take into consideration, something that we have discussed at length, that we discussed at length in India 16, which is property, plant, and equipment. Now, effectively, if in case there is any major periodic expenses, maintenance or overall that is expected to occur, at a later period, okay, that is not considered for any purposes, right? If it is not, it is not resulting due to a legal or constructive obligation, right? So you have to wait for the trigger of that obligation to arise, and that's something which is fundamentally the need for any provisions to be recognized. That's the recognition principle for a provision per se, right? Purely you intending to incur a cost, it simply is not a trigger. It's not resulting in a prudence concept, right? It is something which relates to a future period, and they can only be recognized in case the obligation exists, right? Me, for example, thinking of that, there is a factory, for example. Let's say if I were to make it a little more structured. So let's say if it's a factory, I intend to do some construction, 6 months later, and that would obviously reduce my profits starting that particular period considerably, while I'm making a huge profit today, right? I cannot prepone the recognition of that so-called as cost, the planned cost today, just because my profits are higher today and that can reduce in future. I mean, that would simply be a likelihood wherein you can manipulate with the financial statement. So that is something which is prohibited. So the intention to incur a cost does not make it obligatory onto the company to provide for that expenditure today, right? It's a fundamental accrual concept we need to follow. All right. Similarly, we look at the provisions, just an extension of what we discussed. A provision is only recognized when you don't have a choice but to incur that. You cannot avoid that. That's what the word obligation is all about, right? So a provision is only recognized when the entity has no realistic alternative but to make a transfer of the benefits as a result of the event which has caused this legal or constructive obligation, right? Now, effectively, if I say there is a warranty provision I'm recognizing, okay, I would only recognize, let's say, when there is an agreement to undertake the warranty. Okay. Now we may argue, we may consider that in the first quarter, my assessment is that I would only have a warranty provision of 5 crores, but in the quarter two, this might become 15 crores, right? But in the quarter three, I realized that there is no amount required to be paid because the period is over and nothing was required to be spent, right? So these movements can be dealt with, right? Can be understood under the provisions perspective, but I cannot I cannot simply argue that because in the quarter three it becoming zero, or it could be some other amount also. Then I need to even that out throughout the period. Right? I need to just make it equal throughout the period, because that would make my financial statements appear more consistent. Right? That is not something which you are supposed to do. Right? We are simply saying that obligations could be adjusted upward or downward, and accordingly, any gain or loss might come. It's purely about your best estimate. It's purely about your assessment of what that warranty or an obligation is, right? So that's where you start looking at building it throughout. Okay, and that would be applicable for even an interim period. Does not matter whether you're talking about an interim period or the end of the year. The whole idea is all about, you know, what exactly is the question of fact there, what exactly is the reality, you know, where you need to kind of take into consideration that the periodicity, or whether it relates to a moment within the, you know, the year, let's say during different interim periods, or maybe it's happening within 1 year versus the other, it does not change the perspective at all, right? So we're simply saying the existence or non-existence of an obligation is purely a question of fact. It might be there in the quarter one as well as quarter two. It might increase even further, but in quarter three, if you believe there is none, you don't have to worry about that at all. Okay, right. Moving further, when you look at the adjustments for year-end bonuses, again, you know, there could be different categories, different types of these bonuses. This could be discretionary or contractual, or you know, based on some trends, etc. Right. So that's how you start looking at the types of bonuses, and this would be more appropriately understood under the Ind AS 19 framework, which is employee benefits, right? But essentially, when you look at the accounting for the bonus or the accrual of the bonus, right, you would accrue that, you would anticipate it for interim reporting only if it's a legal obligation or a constructive obligation with the past trends, right? And wherein the entity believes that it has no choice but to obviously pay, and then also importantly that a reliable estimate of the obligation can be made. Okay, for example, you know, if we say that company has a scheme wherein it would, for example, you know, give some long service award. Let's say anybody completing 5 years is awarded with something, right? So the accrual would arise for the entire period, right? So 1, 2, 3, 4, 5. But of course, that accrual would also be, you know, applicable for the interim period as well, right? That is something which is, since the scheme is there, there is a legal obligation. But then, even if the scheme is not present, but in but historically the company has been doing that, so that could also result into a constructive obligation, right? In those cases, it could be, it would be appropriate to, let's say, you know, recognize a provision for such employee benefits, right? And that's how you start looking at it, of course, with a fundamental assumption that you can measure what is the likely cost that you're going to incur in that case. All right. Okay. Similarly, for the vacations, etc., this is again driven, you know, the way we, you know, deal with Ind AS 19 employee benefits. You're talking about in case there are vacations, holidays, or, you know, short-term compensated absences, you need to understand whether these are accumulating or non-accumulating. Right? That's one point, and also whether there has been a past trend where, for example, the entity has been compensating the, you know, the employees for that or not. So if the compensation is not there, right, then you don't have to worry about it. But if the compensation is there, then you're allowed to, or required to, for that matter, create a provision and keep on updating that for each such interim reporting period. Okay, so when you say that accumulating compensated absences are, of course, those which can be carried forward if in case it's not being used in the current, you know, reporting period. Now accordingly, you measure those costs, etc., that you expect to pay, and this would also be the case, of course, for any interim financial reporting period, right? This is certainly more discussed in India's, you know, 19 framework in detail. So whatever we do, the application of that in the full accounting year, we are also required to do it for the same, you know, for each interim period as well, right? As we said that in case it is accumulating and compensated back, you know, amount of the amounted the compensation amount, then you need to kind of create a provision. In case it is, you know, non-accumulating and non-compensating, then you don't have to recognize anything for the interim period or the full accounting year, as the case may be. Okay, right? Inventories, again, the fundamental law of the fundamental rule of cost or net realizable value would apply, right? That's simply the thought process. So it can happen in one quarter or one interim reporting period. There is a write down, right? But maybe in the other reporting period is a reversal of that, right? So that's okay. Doesn't really make any difference whatsoever, right? So we need to kind of look at it that irrespective of the accounting period, whether it's a full accounting period or interim reporting period, the same measurement principles, cost or NRV, whichever is lower, and the reversal thereof, right? They are simply applicable for the entire accounting period as well, right? Of course, entities are normally using estimates to measure inventories for the interim reporting period, which is more of a policy choice, and materiality has to be, of course, respected. So I mean, the whole idea is that stock count or inventory take is not very extensive during the reporting periods, interim reporting periods. Just to use that perspective, companies may use that feasibility or practicability to ensure that the business is going as usual there. But then the measurement criteria, be it your annual reporting period or be it your interim reporting period, the measurement criteria would remain the same there. Okay. Now this is one section, right, wherein this standard expects us to do these calculations and make an assessment of the taxation using something called as an average annual effective income tax rate. Okay. While whatever we have talked about for any other transaction, be it inventories, be it provisions, be it holiday pay, compensation, etc., be it bonuses, etc., you do the same accounting principle following as you do it for the entire accounting year. But as far as the taxes are concerned, we are using something like an average annual effective tax rate. Okay, something that would be applicable to the total expected earning, and looking at, of course, the tax rate which is in general applicable to the business there, right? We'll be doing a calculation around it to understand better in terms of what is the significance or the consequence of looking at this, right? Now the whole idea of using that average tax rate would be talking about, for example, in case there are any changes in the tax rate scheduled to happen, then you are able to bring that perspective of what is the effective tax rate which is applicable to the total income, right? There is a reference which is made here, which is progressive tax rate. Now this could be more commonly used for for a slab based kind of taxation. I mean, let's say there could be a perspective that any entities earning up to 50 crores might be paying 20%, right? But somebody earning up to between 150 and 100 crores might be paying 25%, and anybody earning more than 100% might be required to pay, let's say, a 30% tax, right? So that's where the progression is arising. Different slab rates are being used. Effectively, if I believe that at the start of the year, right, if I believe that my total income is going to be, for the sake of argument, is 200 crores, right? So I know that up to 50, right, up to 50 I'm going to pay 20%, up to 100 I'm going to pay 25%, and for the entire balance amount of 100 crores I'm going to pay 30%. So my effective tax rate will be calculated on what is my total income. So if I were to look at it like this, on 50 I'm paying 10, on additional 50 I'm paying, let's say, that would be 12.5 crores, right? So this is the first 50, this is the additional 50, and then we have further 100, which gives us, of course, 30%, that makes it 30. So in totality I'm paying 52.5 crores on a total income of 200 crores, right? That gives us effective tax rate of 26.25%. Okay, so we need to use this tax rate for all the interim periods. That is something which is the expectation. That's what we have got as a part of this particular concept, right? We'll bring a couple of questions to understand it better in terms of what exactly it means. It says that Reliable Limited reports interim financial statements. For the first quarter, it is earning a profit of 15,000 rupees, profit before tax, and expects to incur a loss of 4,000 in each of the remaining quarters. Okay. It also says that Reliable Limited operates in a jurisdiction with a tax rate of 20% on first 10,000 and 30% on all additional earnings. The question is, determine the tax amount to be shown by Reliable Limited in each of these quarters. Now, effectively, we are saying in the first quarter you made 15,000. So in principle, we're looking at up to 10,000 you're paying 20%, and then for the additional 5,000 you'll pay 30%. So let's do that calculation and see how does it work. Okay, we are saying that quarter one, quarter two, quarter three, quarter four, profit 15,000, and then -4, -4, -4, and let's look at the total. It's 15 minus 12, which is of course 3,000. Now, if I were to look at these quarters independent of each other, okay, so effectively I'm saying the tax that would be applicable on 15,000. Now, this 15,000 is basically 10,000 and 5,000, right? Now, at this, I'm looking at 20%, and here I'm looking at 30%. That makes it 2,000 plus 1,500, which is 3,500. So my PAT will be, of course, 11,500. Okay, that's what we have got. Just kind of reconfirm the tax. It's 20% and 30%, so it makes sense, right? But then the next quarter, I'm looking at a, let's say, reduction of my profit. Now, this is still my total profit would be 11,000. So this 4,000 pertains to the 30% bracket. So I may argue that this is 1,200. So this is basically a reversal of tax expense, which makes it, of course, 2,800 here. Okay. And then if I look at my quarter three, basically what is happening? My profit in, cumulative profit from 15 to -4 to further -4, it becomes 7,000. Okay. So when I look at this incremental 4,000, a -4,000, right? There is 1,000 which comes from the bracket of 30%, right? Let's try to explain that. What I'm trying to say is that 15 and 4 together make it 11, and then up to this date, this becomes 7. Okay. So from a journey of 11 to 7, right, my tax bracket is changing, right? So up to 10,000, I had a tax bracket of 20%, and above 10,000, I had a tax bracket of course, let's say, 30%. So the 1,000, which is between 11 and 10, the tax must have been 300, at the rate of 30%. And for the remaining 3,000, the tax must have been, of course, at the rate of 20%, which makes it 600. Now that would become a total of 900, thereby resulting into my net profit or a net loss of 3,100 in the quarter three. And finally, I look at quarter four, which is again a loss of 4,000. Now from 7,000, I'm having a net income of 3,000 only. Now on this 4,000, I may argue that the rate is 20%, which means that I'm looking at a net loss of 3,200. Now, essentially, we are trying to say that this 11,500 minus 2,800 and minus 3,100 and 3,200. Let's do that, by the way. 11,500 minus 2,800 minus 3,100 minus 3,200. Now, this becomes 2,400. Of course, that is the net tax, right? That's what we have got. Now, when you apply this, when you apply the actual tax rates, right, there is a little inconsistency being observed, especially when you look at the quarter two, quarter three, and quarter four. What you observe is that while your losses are the same, 4,000, 4,000, 4,000, your tax deductions are changing, 1,200, 900, and 800 respectively, and thereby, of course, changing your net losses also, right? So to avoid this anomaly, to avoid this inconsistency, what my standard is suggesting, you look at the totality, look at the net result, which is 3,000, which is the overall profitability that the company has made. And on that, the applicable tax rate is, of course, 20%. This is your, effective tax. This is your effective tax rate on the final income that you expect to receive. Now, if I've used this 20%, it simply means in quarter one, where I have a profit of 15,000, I shall book a tax expense of 20%, which makes my net income at 12,000. In the quarter two, where I have a loss of 4,000, I will have a tax deduction available to the extent of 800, making my net loss as 3,200. And so shall be the case for the quarter three and quarter four as well. Okay. This is something which is expected to be reported when you look at the interim financial reporting as far as the tax calculations are concerned, right? The effective average tax rate is something that we need to calculate, we need to apply from the perspective of, the interim financial reporting standard. Okay, that brings consistencies, that brings, of course, a more appropriate measurement for your tax calculations for all these reporting periods, right? It becomes obviously become more logical to show this and make it more reliable set of financial statements for the companies as far as the users are concerned. Okay, right? And that's what the solution is. Your eventual net income is 3,000, on which the tax eventually has to be, applicable at 600, which makes it, of course, 20%, which is your average annual or effective income tax rate. So net, you are going to report your tax expenses of, let's say, 3,000 as far as the first quarter is concerned. There's a refund of 800 in each of these respective quarters, quarter two, quarter three, and quarter four. All right. Now, this is the only, calculation based scenario which you got in this particular entire, standard of Ind AS 24 there. Okay. Again, I think what you need to remember here is you bring, the context of Ind AS 8 in case there is a change in accounting policy, right? In case there is a change in accounting policy, unless there is a new Ind AS which comes into the picture for which transition, aspects are provided. Now, in this case, a change in accounting policy, you need to restate also the prior interim periods, right? And that is something which is the retrospective application that we deal with under Ind AS 8 any which ways, right? So if I'm reporting it in a particular quarter and I'm also reporting it for the previous year, so those adjustments as applicable also need to be made so that the comparability is achieved. Okay, the comparability is achieved, and that is how you start looking at, of course, the application of a change in accounting policy, which we do on a retrospective basis. However, in case it is impracticable to determine the cumulative impact, then you need to, of course, look at it that you are able to apply it at least on a prospective basis or from the earliest date practicable, right? There's a detailed guidance again, which Ind AS 8 addresses, right? Where you talk about whether it is feasible or practicable for entities to really go back and apply those changes in the accounting policies. In case that is not there, then you disclose that fact and you see to it whatever is the earliest date from which this change in accounting policies can be practically applied. Okay, right? Let's have a look at this scenario. This is more to do with the understanding, how do you look at the impact of, changes in some information on the interim reporting periods. Are these appropriately dealt with in the scenario or not? It says that Sigma Limited is a leading sports shoe manufacturer in India. It prepares and reports interim financial statements. For the quarter 3, the company has presented and reported a net profit of 10 lakh rupees. The profit is derived after making the below mentioned adjustments. It says that bad debts of 50,000 rupees, which were incurred in quarter 3, out of this, Sigma has only written off 50%, and the remaining percent is deferred. Remaining 50% is deferred to be recognized in quarter 4. Okay, well, should we do that? The answer is no, because in case there's a bad debt incurred, that should be applied in full. So that would change, for example, our our net profit for the quarter. Okay. It also says that Sigma Limited has changed the method of depreciation from a WDV to straight line method, and hence it has recognized additional depreciation of 2,25,000 rupees. Now, that should not be a problem because it is purely a change in the estimate, and from that perspective, that is something which is all recognized in the same manner. So we don't expect to make any changes on this. The third one says administrative expenses of 2,50,000 rupees for the quarter is deferred to the next quarter based on the estimate of higher sales in the next quarter. Sigma believes that higher costs can be charged against higher sales, and these expenses are incurred equally in each quarter. The question is, what should be the correct net profit reported? Now, importantly, in this case, you look at the third scenario. This 2,50,000 rupees, the deferment is not permissible. You have to, of course, recognize it purely on an accrual basis. So this entire 2,50,000 rupees is chargeable to the same quarter, right? So when you look at the scenario, we're talking about 10 lakh rupees as your profit, right? It was a bad debt, only 50% was recognized. So we need to also recognize additional bad debts. Right. And also, we're talking about 2,50,000 rupees of administrative expenses, right? The administrative expenses, 2,50,000 rupees, which were deferred, not allowed to be done. So that would mean we're talking about a profit of 7,25,000 rupees for this particular quarter, right? Let's have a look at the formal solution. We are simply saying that in the given scenario, some of the adjustments are not, of course, under the requirement of Ind AS 34. So we say that as far as the bad debts are concerned, we need to recognize that additional cost, right? Additional depreciation, it is correctly accounted for, no problems at all. And as far as the administrative expenses are concerned, since these are incurred, so the treatment to defer those expenses again not appropriate, which means that my net profit reported should be, let's say, 7,25,000 rupees there. Okay, right. That's a straightforward question that we have got here. Right. Finally, on the disclosures front, we need to disclose in case there are changes in accounting policies. Right, that is something which is any which way is covered through Ind AS 8 also. In case the business is seasonal or there is a cyclicality, cyclicality of the business, then you need to give the comments around that. Any changes in the nature or the amount of the estimates, they also need to be kind of explained. Any unusual items, right? Issues, repurchases or repayments. Now, this is purely a material event, right? Specific cases, we need to disclose those as well. Similarly, any dividends being paid need to be disclosed separately at an operating segment level. Now, this is again Ind AS 108, right? So that needs to be also disclosed at operating segment level. Finally, we talked about, of course, instances, any material events, for example, write-off of inventory or reversal, etc. Similarly, any changes in the composition of, the entity in case there's a business combination, you're acquiring a business, you're losing control over subsidiaries, restructuring, discontinued operations, any changes in contingent assets and liabilities and fair value disclosures, they all need to be also disclosed at each interim report basis. Okay. Similarly, we talked about all these items of material events, inventory write-downs or reversals, impairment losses, acquisition, disposal, etc. for property, plant, equipment, litigation settlements, reversal of restructuring, related party transactions, loan agreement breaches and defaults, they all need to be again, reported as a part of each financial, period as far as the interim reporting is concerned. Okay. Finally, we got the key differences under the AS framework versus the Ind AS 34 framework. Specifically, when you look at a complete set of balance sheet, that would also comprise of, having an opening balance sheet in case there is a change in the accounting policy, right? That is something which is specifically there. This is also the same requirement as triggered by Ind AS 8, which is provisions, which is accounting policies, changes in accounting estimates and errors. So that's where it is driven, that even for the interim period, we need to, explain that part, right? But this is not something which is included under the AS framework. Likewise, when you look at the dividends, you need to disclose that dividend at an absolute figure purpose. The per share value or the aggregate amount has to be reported. But from the AS framework, AS 25 says that dividend has to be disclosed in absolute or even a percentage terms. That's something which is the difference between the two. As far as the contingent liability or assets are concerned, Ind AS 34 is a little more, liberal in seeking information for both. So the positive and negative both are covered, but AS 25 would only require the information on contingent liabilities. All right. Thank you very much.